how do we account for if an owner is wanting to invest or put some capital into the business? So let's say we have an owner and his name is, say his last name is Adams. Okay, so his capital account would be called Adams Capital. And he wants to put $10,000 into the company. Okay, so what would that look like? Well, we'll assume today is the 14th. And from the company's perspective, we're going to debit cash for $10,000. And then we're going to credit Adams Capital for $10,000. And I'll put a description here just so, because I'm recording this, so when I post this, if you want to review it again and you want to look at what each one of these is actually telling you, then you can look back in and at least get a template down. So if owner contributes to company, okay? And I'm just going to assume that all of these are October 14th, so I'm not going to add a new date each time. Okay, so now, let's see. We purchased some land for cash, okay? So let's say the land is worth $50,000. So we have a land account, that's an asset account, worth $50,000. So that's what we put in there. And our cash account is credited or reduced by $50,000. Okay, so in this entry, we're basically just switching from one asset to another. We're changing the asset of cash. So we got $50,000 coming out of cash, and then the asset of land is being added in its place. Okay, so if I were to ask you, and I don't think I'm really going to put any of these on the midterm, but they may show up again towards the final, and you definitely should understand how this is working just in your head. But if I asked you how that affected the basic accounting equation, you would tell me that that's basically all taking place on the left side of the equation, okay, under the asset side. One asset goes down 50,000, one asset goes up 50,000, okay? So bought land for cash. Okay. Purchasing office supplies for credit, okay? So office supplies is a type of asset, and we are purchasing it for credit, which means we owe someone in the future. So let's say this is $2,000 worth of office supplies. We'd have a $2,000 debit to office supplies. And then since it's something that we're going to owe in the future, it's got to be some type of liability account or a payable account. So we're increasing our liabilities by $2,000. So again, in terms of the basic accounting equation, office supplies, which is an asset, goes up $2,000, and liabilities, accounts payable, also goes up $2,000. So that stays in balance. Okay? And you see that all of these entries have an equal number of debits and credits, so that stays in balance. Okay, so earning revenue. This should be a pretty basic thing that every company hopes to do. So we're going to assume that we earned revenue and someone paid us in cash for that revenue. So we'll say that we're a service company and we earned $20,000 worth of revenue. They paid us in cash for $20,000. The credit side is service revenue for $20,000. Okay, and again, in terms of the basic accounting equation, assets go up by $20,000, and an increase in revenue causes owner's equity to go up by $20,000. So you still have a balance there. Okay. Okay, so now almost the same thing, but instead of getting cash, we do revenue. We perform services for someone, and they promise to pay us. Okay, so we got to record that promise to pay. It's still an asset, but now instead of being cash, it's recorded under accounts receivable. We'll say it's for $10,000. Again, we are still recognizing that as revenue for $10,000. Okay, so again, in terms of the basic accounting equation, it looks just like the one before it, because accounts receivable and cash, while they're not exactly the same thing, they're both short-term assets, and we treat them pretty much the same way because we hope to convert those accounts receivable into cash very quickly. Okay, so it looks almost the same in terms of the basic accounting equation as the one before it. And then in terms of the journal entry, we just want to make sure that we are keeping track of who owes us what money. Okay, now we're going to pay some expenses, and we're going to use cash to pay those expenses. Okay, so remember, anytime I record an account named expense, okay, the expense always goes in the debit section, right? So let's say that I'm paying some rent expense and I'm paying some salaries expense. And the rent was $2,000 and the salaries were $7,500. Okay, so now I have two debit entries, and since I'm paying with cash, the credit entry is just going to be to my cash account for the total of those two put together. And I show that cash goes down by that amount, and I've recorded the expense of rent and salaries expense. So again, in terms of my net income, since I've put that into an expense account, that will affect my net income. And in terms of the basic accounting equation, whenever something's recorded as an expense, the expense account goes up. That means the owner's equity goes down. Okay, so in this case, we have assets, cash going down. So that's the one side of the basic accounting equation, and expenses going up. So owner's equity goes down as well. So we balance there in addition to debits and credits. So paid some expenses with cash. And remember, it's okay to use these templates to record them, to say, okay, anytime that I am performing some services on account, it's going to look like this. But remember, I saw this a lot on some of the quizzes. You can't necessarily plug these in word for word if you're doing another entry. So like, if I ask you to do an entry to record some expenses paid with cash, but the expenses I'm asking you to record are not rent or salaries, then obviously you wouldn't use rent or salaries expense to record those. If I said instead to record interest expense paid with cash, then obviously your expense account would need to be named interest expense. So, use these templates, keep them, use them as a reference, but remember that you do have to customize them a little bit when you're changing around different scenarios. Okay, so now this account payable up here for $2,000 that we already did, we owe that money, and now we're going to pay it all off. Okay, so we had up there, we have a credit of $2,000 in the accounts payable account. We want to get rid of that balance, so I'm going to want to debit that account for $2,000. And obviously, if I'm paying off a debt, that's going to be done with cash. Okay, so I have a credit to cash showing that my cash is going down, and a debit to accounts payable showing that my liability is going down. So on the one side of the equation, I have assets going down. On the other side, I have an equal amount of liabilities also going down. So we stay in balance there. Now, this accounts receivable up here that we had, we're going to say that we collected on that. Okay? So the customer from that journal entry has decided to pay off their account. So they're going to pay us in cash. They're going to pay the full amount. So cash goes up by $10,000. We want to show that we no longer are owed money by this company. So accounts receivable is going to go down by $10,000. Received money for receivable. Okay. So again, this is another one of those scenarios where we just have one asset turning into a different kind of asset. So now instead of an IOU, which we considered almost equal to cash, we're exchanging that, getting rid of the IOU, and receiving cash for that. Okay, now the owner says, okay, the company's doing well, but I need some spending money, so the owner is going to withdraw $5,000 cash. We said this was Adams. So we have a debit to Adams withdrawals, and Adams is withdrawing cash. So we have a credit to cash. Okay, so asset, left side of the basic accounting equation goes down. Owner's withdrawals causes the owner's equity to also go down. Okay. Prepaying an expense. Okay, what does that look like? Well, if I want to pay for 12 months worth of rent ahead of time and each month is worth $1,000, then I'm going to debit an account called prepaid rent for $12,000. And the credit is going to be to cash for that amount. And remember, these type of prepaid expenses leads us to having to do some adjusting entries, because as time passes, we have to record the fact that the asset of prepaid rent is kind of disappearing, and we are recognizing expenses. Okay, so at this point, all we've done is change one asset to another asset, and now as time passes, let's say 3 months goes by, and we have to do financial statements. So now we're going to do the adjusting entry that causes 3 months worth of this rent to disappear and be recognized as an expense. Okay, since we're recognizing it as an expense, we have to have an account called some type of expense. So in this case, rent expense. Each month is worth $3,000. So we have a debit to rent expense for $3,000. I want prepaid rent. I want the balance in that account to no longer be $12,000, but to actually be $9,000. So I need to do a credit, since I have a debit there already, a credit of $3,000 to lower that to $9,000. So that's what the other side of this one will be. Okay. So that's after 3 months has passed. We did the adjusting entry. We recognized $3,000 worth of expense. And if we looked at the T-chart of prepaid rent, it would now have a balance of $9,000 in it. Okay. And in terms of the basic accounting equation, we have an asset going down by $3,000, and we have an expense of $3,000. So again, an expense causes owner's equity to go down by that amount as well. Let's do that one. Okay, now we're going to buy a building, but we're not going to pay cash for it. We're going to use essentially a loan or something we call a note payable, which is basically an IOU, but it's more formal than that, where you're actually signing loan documents and such. So we'll say we're going to buy a building worth $50,000. So our building account is going to go up by $50,000. And we're going to record a $50,000 liability. So that needs to be in a payable account. And in this case, I told you that was going to be a notes payable. But if I didn't tell you and I just said we're going to buy it on account, any type of payable in there would be acceptable. Accounts payable, notes payable, whatever you thought was most appropriate. But since I said notes payable, that's what you should use. Okay, so basic accounting equation, building is an asset, obviously, so assets go up and liabilities go up by that same amount. So we're still balanced. Okay, let's look at another adjusting entry. Okay. We already looked at the effect of prepaid rent. Now let's look at what an accrued liability looks like, or an accrued expense. So let's say now we receive a $300 telephone bill that we haven't paid yet. Okay? So when we receive it, we owe the money. We're going to say that we have an expense account called telephone expense. Okay, so we record $300 worth of telephone expense, and we also, since we haven't paid it yet, we need to put some type of IOU on the books that shows that, you know, we recognize that we owe this money, but we haven't paid it yet. Okay, so again, that's a liability. Whoops. Okay, so this is when we receive the bill, we record the expense and that we're going to pay it, and then if we wanted to record what happens when we actually pay the bill, whenever that is, we would want to show that accounts payable is going down, meaning that we don't owe that money anymore, and we're losing some cash. So since $300 a credit entry caused accounts payable to go up, the debit side is what causes it to go down. So that entry there is the one that you would do when you got the bill. And that entry there is the one that you would do when you paid it off. That's another issue that a lot of you guys had on the adjusting entry questions, was that when we went over those in class, we had a lot of before and after. This is what we do when we get the bill. This is what we do when we pay the bill. And then if you were asked a question about what this one looked like, and you were supposed to put this template in there, a lot of you went ahead and put this one in instead, because you knew that that was part of the transaction, but you weren't sure which side of the transaction you're talking about. So again, you got to make sure that you understand which which template goes with what's actually happening in the scenario. Okay, so when you receive the bill, it's the expense and payable, and then when you pay the bill, it's the payable in cash. Okay. All right, let's do an unearned revenue one. Okay, so let's say that we received $30,000 prepayment for a service job that we haven't done yet. Okay, so we have not earned the revenue yet. We need to record that we got the cash, but we also need to record that we owe something for that cash still. So we've got a $30,000 debit to cash and a $30,000 credit to unearned revenue, which, again, is a liability account. Okay, it's the only account that has the word revenue in it that's going to be a liability account. Okay, so this is recording receipt of cash that is unearned. Okay, and again, down the road, obviously, we're going to eventually earn that money. Okay, and this is, I know we had a question on one of the quizzes that was like this, and this is what I wanted. And what a lot of you put was the entry that showed what happens when you actually earn the money. Okay, so when you actually earn the money, you want to reduce the liability. Sorry. Still getting over that cold. Okay. So the liability account has now gone down by $30,000, and those cancel each other out, so that's now a 0, and we would show earned revenue. Okay? That's when we actually earn that money. Okay, so we basically covered at least one example of all the different types of journal entries that you might see. Okay. So then the only other big steps that you're going to have to do on the exam are going to be transferring this information to the T-charts. Does everybody remember how to do that? Okay, that should be pretty easy if you remember debit is left, credit is right. And then you just have to find the balance of various T-charts and then pull that balance out and put it in the adjusted trial balance. Okay. See if there's anything else I really wanted to go over. Anybody have any questions? Everybody confident? Yes.
This is going to be like on YouTube, like you did the last time.
So this, what we just did, I'll put on YouTube. And then, like I said, once I post the exam, I'll also post a little walkthrough on YouTube that shows exactly where I want you to match things up to. Okay? Yes? There's no timer. You should be able to, as long as you save your answers, you should be able to get in and out as much as you want. Okay? Any other questions? Please, on my syllabus, which is on Blackboard, has my cell phone number on it. So if you run into trouble while you're doing it, text or call me, and I'll get with you. Okay? Any other questions? Where's that attendance sheet? You got it? Anybody not sign the attendance sheet? Okay, come up here and sign it before you leave. All right, that's all I have.